Thank you very much. It's a great pleasure to address this very distinguished audience 10 years after my first participation in actually this forum. It has become, as Adam said, a formidable forum for discussions and open debates. So I'm really looking forward to those during this day. And I'm not a fan of fragmentation. So as you can see, I'm part of the ABFER, the CEPR, and the NBER. So this paper today is going to touch upon, with an analytical mind, some of the issues that Adam has brought to the table, only a subset because he had an extremely rich presentation, which gives us a lot of additional food for thought. I'm going to be discussing some joint work which I've been doing with my colleague Vanya Stavrakeva from the London Business School on how to create some international finance framework to better interpret, in particular, the current turbulent episodes in international finance. Okay. I didn't want to emphasize it. Is that better? Yes? Very good. So the main motivation for this paper is to try to understand better some of the old topics and important topics in international finance, in particular the interconnection between exchange rates, asset prices, and here I will talk a lot about equity markets in particular, and how their fluctuations propagate in a way in the global network of international finance. As we know, these asset prices and the exchange rates are key to a number of important stabilization policies that we perform, monetary, fiscal, and also financial stability policies. So I will talk about linkages empirically that we can observe between cross-border portfolio flows and stocks and bond prices. And this will allow me in particular to revisit some of these recent turmoils that we have been witnessing, the famous Trump tariff episode in particular, where, as Adam alluded to, we have seen some pretty uncommon co-movements between asset prices. And I think so far we lack in the literature unifying frameworks to discuss those issues. I will build to discuss these topics on this recent work that I quote here with Vanya Stavrakeva. Now, obviously, this is a very complicated topic, and very often the links between exchange rates and asset prices have been looked at through the lenses of the bond market. So it is a little bit where the lamppost is in the whole literature. And here I'm going to move the lamppost, and I'm going to put the spotlight in particular on the equity markets and the link between equity markets and exchange rate. So the first thing I'm going to present here is the evolving nature of the architecture of a network among all or most of the world economies in terms of portfolio finance. And I will compare in particular 2008 and 2023 as kind of two benchmark years, but then I will also look at the time series of what is happening. I will then use a very simple analytical framework based on market clearing conditions. So this is the framework, therefore, that has to be useful for any models one can write in international finance, because we always write down market clearing conditions. So if my market clearing conditions tell me something interesting, well, this thing will have to hold in any study that we may want to do on this topic. And I will use this framework to guide me to construct a high-frequency proxy of portfolio flows. And this is what I will use in order to interpret some recent episodes, such as COVID, but also what happened after the global financial crisis and the tariff episode. So the way I think about this new tool, this new framework, is really to guide us to understand these changes in the potential structure of the international financial system, and in particular, the step down that Adam talked about the international role of the US dollar. Some of you might have seen that I've also written recently some op-eds in the Financial Times and and project syndicates about the potential international role of the euro. And so I think indeed that there's a number of policy actions that could be taken in order to foster that role. But precisely in that spirit, I think it's important to understand what's happening in the network of international financial flows and asset prices to be able to A, monitor what this transition may mean, and B, understand better the disruptions. So this is really in that spirit that I'm presenting this new analytical framework. So the lamppost is now on the equity markets and the link with exchange rates. So what we usually don't take much into account in international finance is that when there are international equity portfolio flows, so there are two correlated transactions which take place, one transaction in the foreign exchange market and one transaction in terms of buying an equity in a stock market, say here, a domestic Brazilian stock market. And we usually have many different investors coming from different currency areas who are going to be investing in these markets. So here, mainly, we're going to see a lot of flows coming from dollar asset pool, but also the euro asset pool and sterling. And there are also many other, obviously, investors in the world economy that are all going to be participating in all international equity market. Hence, the world is going to look a little bit more complicated than this picture. And this is what the world looks like in a little bit slightly more complete way. This is the global portfolio equity network. On the left side, you have 2008. On the right-hand side, you have 2023. Now, the size of the node is proportional to the equities of each of the countries that are in those nodes, normalized by the US GDP of the relevant year. And the colors actually mean something. So the brownish colors means that the portfolio finance is dominated by debt. And the more you go to green, the more it means that the portfolio finance flows and international flows. And so the total liabilities of the countries are dominated by equity. So as you can see, there are several striking things going from the left to the right. So first of all, we tend to see, I think, an increase in density of links and multipolarity. We had three big nodes. We had the US, the euro, and sterling, actually, which were very dominant in the international equity network. But they are brownish, so that means that, in fact, in portfolio finance, they were still dominated by the debt side of things. As we move towards 2023, we go to the green, so we see a very important growth in those nodes, in particular the US node, but also the euro node, and there's more equity financing. We also see a number of alternative nodes emerging, so multipolarity is actually rising, and it's rising both among advanced economies and also among emerging markets. So there is a significant increase in deepening in cross-border capital markets, and a lot of that, the rise, turns out to be towards equity financing rather than debt. And there's, I guess, a bit of also of a shift in terms of the US and the euro area becoming net long equity, from net long equity in 2008 to net short equity in 2023. Now, I can present the same network, but this time it's based on the portfolio debt data. So again, the size of a node is proportional to the debt liability here, normalized by the US GDP of the relevant year. And we see, so same colors, we see that we've got from more debt financing on the equity side to more equity financing. But what we see here is that the three big nodes, among them the US being a very big node, kind of remained a little bit more dominant maybe here. There's a little bit less of a multipolarity emerging in the portfolio debt network. So the way I would characterize that is that we do see some structural shift in how countries tend to finance themselves, a little bit more towards equity. We see that the debt liabilities remained a little bit more relatively concentrated than the equity liabilities. So this has, of course, implications for the risk sharing in the global economy. We tend to think that it's a good thing if we have more state contingent assets which are used in international flows. Now, obviously, if we want to discuss, and this is something I've worked on a lot with Pierre-Olivier, the role of a dollar as a world banker, etc., we would need to go beyond this portfolio flow data and also look at the entire structure of a balance sheet and discuss the issues along the lines of our paper on exorbitant privilege and exorbitant duty. Now, an interesting footnote based on this data, of course, is that the more the equity liability side of the US grows, and as we have seen it as grows, the lower the exorbitant privilege, because the returns that the foreigners get by investing in the US has tend to go up over time, as opposed to being completely dominated by investment in US treasuries. Now, obviously, also, the status of the US as an international currency hinges a lot on the safe asset, as Adam also discussed, and the market of US treasuries is still by far, so in terms of safe assets, to the extent it's still safe, is still by far the biggest market in the world, right? So this is definitely one of the challenges that the euro area, for example, has to deal with when it thinks about being a competing currency with the US dollar. All right, so I'm just going to go rapidly, quickly through the time series evidence, because essentially it's just to convince you that this snapshot, the 2008 data and the 2023 data, were not really special. We do see on trend a relative increase in equity positions. So here this is the US with Cayman Island, Bahamas, and Bermuda being rewired into the US. And you do see that the green bit, which is the equity positions on the assets and liability sides, tend to grow faster than the debt bit, which is the other color here. This is going to be the same as well for the euro area. And you can see the green bit in particular on the liability side, but also on the asset side is growing very quickly for the euro area. And this is a number of important financial centers also in the region. And we see similarly that actually the equity side, particularly on the liability, has been growing at a very, quite a high rate of growth here. So this is indeed a general trend that we can see in the international portfolio finance network. Now, another way to look at this data is to look at it through those colorful graph again. Here. So what do we have here? We have on the horizontal axis the measure of total liabilities, portfolio liabilities divided by GDP of the relevant country. And on the vertical axis, we have a portion of equity finance in external liabilities. And again, on the left, you have 2008. On the right, you have 2023. This is advanced economy. This is a bunch of advanced economies. And what we can see is everybody is kind of moving up, right, over time. Moving up, again, means that we have more equity in external portfolio liabilities in 2023 than in 2008. What we also have, if you look at the little colors here in the pie charts, are the countries which are investing in those liabilities. And you can see a lot of the blue and quite a lot of the orange. The blue is the US dollar capital, and the orange is the euro area, right? So we see clearly that there is some countries which are main financiers, if you like, of these equities, and they tend to be the United States and the euro area. Now, this was for advanced economies. We have pretty much a relatively similar picture for emerging markets, where here it's a lot more dispersed, the amount of equity liabilities in total portfolio finance liabilities. However, you do see that for most countries, there is also a moving up, and some countries, so it's a bunch of emerging markets and advanced economies here, some countries have moved up quite significantly. So again, however, the financing countries are still pretty much, we still see the US playing a very important role and the euro area as well, both on the equity side and on the debt side. Okay, so I think this is a pretty consistent picture across all my graph that I've given you on the time variation in the international financial network among a lot of the world economy, emerging and advanced economies. Now I'm going to put a little bit of theory behind the analysis to allow us to move to more interpretation of in particular the recent episodes that we have lived through. So I'm going to start simply from a market clearing condition on equity markets. So again, this is something that has to hold in any model that we're going to write down in international finance. Therefore, any of the stylized facts, if I feed the data, if I manage to put some data around that identity, any of the stylized facts that I'm going to be extracting from my analysis would have to be true in any analysis, any finance model that we are going to write. Okay, so that's why I think this type of framework is useful, is because it's extremely general and it nests any approach that one might want to take. So in the paper on currency centrality and global financial cycles with Vanya, we write market clearing condition for each single stock, more than 20,000 stocks which is trading around the world, and we show that we can actually reconstruct the market clearing condition with a very good fit for each of these single stock. So here I'm going to take a step back, and I'm going to take only macroeconomic data. I'm going to take the CPIS data of the IMF, which is the corresponding macro data, which is the cross-border position in equity and debt of all the bilateral positions of all the countries around the world. And I'm going to use this data to construct empirically this market clearing condition. So the market clearing condition is very simple. It tells you that on the left-hand side, the capitalization of, let's say, a Brazilian stock market, so is equal to the price of a stock market, that's the P, the quantity of shares, that's the Q, has to be equal to the holdings of a stock market by all investors around the world. So here, this is going to be, at the country level. And these investors, so this is going to be the demand holdings, if you want. These are the Ds here. They are coming from different currency areas. So we have a lot of dollar investor, we have a lot of euro area investor, et cetera, et cetera. And so in between the investor and the stock market, we have an exchange rate, right? In order to translate the currency of the investor into the currency of the assets that investor is buying. This is particularly important for equity market, and I guess this makes also them quite different in some way from bonds market, because a lot of equity investment is not hedged for currency risk, while a lot of fixed income investment would be hedged, right? So this is another additional reason why it's actually interesting to study jointly equities and exchange rate. So I'm just going to manipulate this equation a little bit. I'm first going to be linearizing it. And so this is the second equation that you have there. And I'm just then going to manipulate it a little bit to get to the bottom here of the equation, where you're going to have the change in the price. So that's the growth of the stock price. That's the delta P. Minus, this is going to be an exchange rate, which is weighted by the network. Okay, these are the average network weights here, the news. And this, so these are two prices on the left-hand side. Because of the market clearing identity, this change in price of the equity price minus the change in this appropriately weighted exchange rate has to be equal to the change of the appropriated weighted demand of holdings demand of all investors in that stock market around the world, minus the change in quantities of shares in that stock market. Okay, so that's again just the linearized market identity. And now I'm doing a few things here that I won't get into, but taking this linearized identity, I'm going to be able to use the CPIS data to just reconstruct it and see how well I am doing. So essentially what I'm going to be testing is a market clearing identity linearized and the quality of the CPIS data, and see how well I can fit that. And I'm going to do that from the equity side. I will also do it for long-term debt. As you will see, the equity side will fit a lot better. So what do I have here? I have this market clearing identity. On the left-hand side, I have essentially this variable that I call delta H tilde, which is based on prices, which is has to be equal to the which has to be equal to this sum of the news delta D, which are essentially the demand holdings, the change in demand holdings coming from the CPIS data. So this delta H is the annual growth rate of stock of cross-country equity positions. This is quantity data that I observe in the CPIS. And on the left-hand side, it's what it has to be equal to, which is what we call the implicit foreign equity holdings, which are constructed only from price data because of the growth rate of the stock market and the appropriately weighted exchange rate. So on the left, I have only change in price. On the right, I have only change in quantities. They have to be equal. And then there's a residual, which we assume to be small, but this is precisely what we are going to be testing. And we could write the same type of manipulation for long-term debt. Now, how well are we doing with our reconstructed implied equity holdings from price data? Well, so here you see that we're doing really well. So this is the CPIS equity holdings are in red, so the actual quantity observed from the data. And in blue, this is the price implied holdings. So you see that we are essentially managing to fit this market clearing condition, even with this very annual macro data, kind of, pretty well. And this is going to be true here across all our country, advanced or emerging markets. Now, if I do the same exercise, but I use the CPIS data for long-term debt, I'm going to do a lot less well, and there are a number of reasons why this is the case, but you can see that the fit there is not really good, right? And so the reason why we're not doing as well is because the debt holding, so first of all, we do it in a very coarse way. We take 10-year prices here, whereas the debt is lots of different maturities. But most importantly, it's much harder to test the market clearing conditions for bonds than for equity because bonds are issued and mature all the time. While for equity, actually, we don't have this problem. And so this is why when we do this type of exercise, actually also in Morningstar data, using very granular data, we get also an extremely good fit with the stock at the stock level. And we can really fit every market clearing conditions, while I'm not confident that if we were to try very granular data on bonds, we would get as good a fit, actually, and it would require a lot more effort. Okay, so how good is the fit? Well, we can precisely do we do a variance, in a way, covariance decomposition of just our identity. So if our fit is good, we should be around 1 for each country. You see that we are not around 1 for all the countries, but we are not that bad either, right? And actually, we do pretty well. So the fit that you could see, if we could eyeball in my graphs before, is still pretty good here. That's very good for the equities. That's not so good for the long-term debt data. So it's consistent. Now, because the fit is good, we can take the two components of our price, reconstructed price, implied position, which are the growth rate of the equity price and the exchange rate, and we can look how much of the variance of the position is explained by the exchange rate and how much is explained by the equity price, and we can look at how they co-move, right? So we can literally do a variance covariance decomposition of the holdings, which is what we do here. So when I look at the co-movement of the exchange rate on these holdings here, that's again the equity. Let's focus on the equity. It's in blue. So we find that for pretty much every country, you see these blue bars are negative, which means that there is an appreciation of a local currency. So what does it mean? It means that when we increase the holdings demand for every single currency, for every single country almost, what does the market clearing condition give you? Well, if you increase the holdings demand, there are two prices that can adjust. There's the price of equity and there's the exchange rate, okay? The price of equity goes up. We are going to see that here. It goes up, okay, for everyone. The blue bars are all positive. That means the price of equity goes up with the increase in the demand holdings for that stock market. And what about the exchange rate? Well, the exchange rate, it tends to appreciate in most cases. So the two prices tend to adjust to clear the market. Price of equity goes up, exchange rate appreciates. These two things clear the markets. In which proportion? Well, it depends. And that's actually there is very interesting heterogeneity across the countries. That's what you see here. In some countries, the exchange rate moves more. In other countries, the stock price moves more, okay? And that's obviously interferes in a way with managing exchange rate, etc. So there's volatility going somewhere when one manages exchange rate, given that the markets has to clear on the always. Now you also see that in this graph there are 4 bars which are positive, which means that the exchange rate depreciates instead of appreciating. And those 4 bars, and this is something we consistently find also in the granular data, are the US dollar, the Japanese yen, the Swiss franc, and the Hong Kong dollar. Okay? So these are the flight to safety countries. So these guys have a very different dynamics. Okay? So in those cases, the exchange rate moves against clearing the market, the equity market, right? So that one interpretation of what's going on is that for these countries, what is dominating are the movements in fixed income, which are going to be marginal for the exchange rate. Okay, so from our decomposition, I think we can learn a few things, because the data, we can reconstruct the market clearing. So, if we have market clearing, we can have a few stylized facts that are going to be true regardless of any model we're going to be thinking of. And so what do the data tell us? Well, that asset prices and equity price move in an heterogeneous way across countries to clear the markets. In some countries, if we are managing the exchange rate, actually the equity price will move more to clear the market. And in other countries, if the exchange rate takes more of the appreciation, the equity price actually will move less, okay? And so that's interesting. There's a sorting that can be studied further. For most countries, the exchange rate movements tend to be stabilizing, it dampen the equity price fluctuations, except for 4 countries, the US dollar, the Japanese yen, Swiss franc, and the Hong Kong dollar. So now that means if we look at things from a point of view of an investor, some countries have different hedging properties than others. So if we look at the co-movements between exchange rate and the stock price, for someone who is investing in the US from the rest of the world, investment in US dollar markets from the rest of the world comes with the US dollar depreciation on average. So the US dollar functions as a hedge for actually international equity investment. Same for the Japanese yen. This is not the case for the other countries, because as we have seen, the co-movements are different. And this is a more general point that we explore in more detail in this paper with global financial cycles, where whenever we have some measures of a global financial cycle, so here there is this risk-on, risk-off measure of Anusha Shari, which is very correlated with the global financial cycle. You see that in the upturns of a global financial cycle, we see a very strong correlation with the US dollar factors, and in the downturns as well. So you see this, it's a correlation of 70% roughly. What it means is that in the ups of a global financial cycle, the dollar tends to depreciate, and in the downs, the dollar tends to appreciate. So there is this hedging property of a US dollar, which again is linked to the safe haven properties of the US dollar. In bad times, you have people rushing into fixed income in the US, which is going to appreciate. That's going to be the marginal effect, the US dollar. In the good times, we have capital, a lot of dollar capital going out of the US into everywhere else, as we have seen. And if it goes into everywhere else, it appreciates the exchange rate everywhere else, which means that the dollar depreciates, right? So this is why the US dollar factor is actually very strongly correlated with the global financial cycle in a way that provides a hedge for equity investors. So this is something which is fundamental for asset managers, which means it could, given the shocks that we have seen recently, has been changed. This is at the heart of the change in the correlation with a Trump tariff. So we'll come back to that. But I think if we look through what's happening in equity markets and the way they balance, we kind of learn about how this co-movement is happening, in which markets, fixed income might be a defining feature. And so we had these 4 countries so far, but the Hong Kong dollar is because it's pegged to the dollar, right? So it's really the Japanese yen, the US dollar, and to some extent the Swiss franc, that we see this specific co-movement, not the euro, okay? And that's important so far. But again, this is linked to the structure of the network. So this is something that may change, especially if, some of the links of the US dollar network gets altered by current policies. All right, so now that I have this framework in place and that I've shown that we have a good fit of the data, at least on the equity side, we are going to try to move from the annual data to high-frequency data, okay, to understand better what's happening immediately after the Trump announcement, etc. So we are going to go to daily data. And I can do that because I've shown you this good fit, being able to reproduce the quantity data with the price data. Now, the price data is high-frequency. So I can build my implied position data from high-frequency daily price data, which is what I'm going to be doing here. I'm going to show you first that when I use daily price data on prices to reconstruct my equity holdings, and now I run these overlapping regressions at the daily frequencies. So instead of looking at yearly changes, I literally look at 30-day changes here. I have a sorting of my co-movements between equities and exchange rates, again, the blue bar here, which is very similar to what I had with the CPIS data. So that means I reconstructed my CPIS data. Now I use daily price data, and I use a different frequency, it's 30 days. And I have a sorting, which it still gives me, there's a differential adjustment. Some countries appreciate more than others to clear the market. Some equities go up more than others to clear the market. The sorting is, it's not identical, but it's very similar. And in particular, the 4 guys that are still, at the end here, which are still depreciating instead of appreciating, is still going to be the US dollar, the Japanese yen, the Hong Kong dollar, and the Swiss franc. Okay, now, this is the equity price data, and now the correlation with the bonds data also is stronger, but I'm not going to go into that. I focus mainly on equity. I want to make sure that my high-frequency price data does capture something which is related to the demand side and to the quantity side, because that's what it's a proxy for. It's a proxy for my holdings of equity. It's a proxy for a quantity. So the way I ensure that is that I look at a variable which is literally a quantity variable. It's the growth rate of a BlackRock MSCI iShare ETF share, which are sold in the US and are country specific. So these ETFs cover each country in the world. You can have a Brazilian ETF, you can have a Singaporean ETF, etc. And I'm going to be measuring the growth rate of this share, and I'm going to use that as an instrument variable to instrument my my proxy of positions, which is based on prices. I'm going to instrument it and look at how these the regressions then actually whether they change or not when I use this instrumental variable, which is a quantity proxy, and which is there to give me comfort that I'm really capturing demand. So change in quantities, change in demands for a certain stock market. So this is what we do. We regress the shares outstandings of these ETF for each of the countries. We clean there for common effects here. And so what we are left is a demand proxy for the stock market of a cross-section of our countries here. And I'm going to be using these shares outstanding, this change in shares of the ETF to proxy for the demand for my assets. I'm going to be rerunning the change in the equity price on this quantity variable, so which is now instrumented by my ETF shares, and I'm going to do that also for the exchange rate. And when I do that, I pretty much find the same thing. Again, if I look at the change in the change in the appreciation of the currencies, so everybody is appreciating. Again, here the ranking is very similar to the previous ranking I just had. There's been a few changes with the CPIS ranking, but the general philosophy holds. I don't have the US dollar here because for the US, you need to instrument it with ETF shares, which are sold elsewhere for the US market, and there the instrument is not strong. So this is why the US dollar has disappeared. Otherwise, we have similar results. Japan is a bit stronger. So now that I'm kind of convinced that my proxy is actually telling me something about, you know, demand for equities at high frequency, I'm now going to be using this high frequency proxy to discuss what happened in 3 distinct episodes: COVID, the Trump tariffs, and the global financial crisis. So this is the final part of the papers. So I use this high-frequency proxy, and this is what happens during the COVID shock. So it's a 30-day window post-US closure. And so what you have here, you have to see where the zeros are. So on the left, so you see the zeros, which are basically, so on the horizontal axis, you have the relative equity holdings of countries vis-à-vis the US, and on the vertical axis is the relative FX index, which is weighted by the network weight, so appropriately weighted on the left side, and on the right side you have only the dollar here, the dollar exchange rate. So what we see, what it means is that if you are to the left of this dashed line, where the zero is on the horizontal axis, it means that essentially everybody was going more into the US after the COVID, the US equity markets, compared to the domestic equity markets. So most countries are to the left. So there was a general buying of US equity markets and a general selling of everyone that you see on the left, and you can see which countries were the most essentially sold. So you have Mexico, South Africa, Brazil, etc., which are on the upper left. So there is some heterogeneity, but you can see that everybody essentially was sold, except so to the right of the dashed line, you see some equity markets in which the relative equity holdings actually increase compared to the US. And there you have Japan, you have Hong Kong, you have Taiwan, you have China, you have Swiss franc actually. But these are relatively few countries. Most of the countries have been sold on the equity market side. And you see that all the exchange rates essentially have depreciated. The dollar has appreciated compared to everyone. Everybody is above the zero line. So the dollar appreciated across the board, right? And most countries have been sold, and most people have gone into US equity markets. If we look at what happens to the government debt, again, using the same trick, here it's even more striking. Everybody has bought relatively more US debt. Everybody is to the left. So everybody has sold, everybody has been sold in terms of debt, long-term debt, and everybody has bought US. Okay, that's everybody is to the left of the vertical dashed line. And you can see that the dollar has appreciated across the board. All the exchanges have appreciated. So COVID, textbook reserve currency shock. That's what we expect from the dollar being the international currency. Typical co-movements and heterogeneity across countries, but typical co-movements. Okay, what happens Trump's Liberation Day shocks? So here, that's totally a different story. So you see that my zeros here, they are not at all at the same place. So if you are to the right, it means that it's actually the US that has been sold relatively to the others. And so you see in equity, actually, there's a lot of movements outside the US equity markets and some strong inflow into the guys who are most to the right here. And if you look at the exchange rate, it's a dollar depreciation. Only the Turkish lira is up there, right? And there were different reasons why the Turkish lira was up there. So it's really a completely opposite pattern that you see. Again, with an interesting heterogeneity across the different countries, which I don't have time to get into, but it is, completely opposite co-movements. That's the equity market. How about the government debt market? Well, same story. This is unbelievable, right? This is completely changing pattern. So you see the relative debt holdings, most people, have gone out and into these different countries. You see the Swiss franc here, which you see the, essentially almost everyone except again Turkey. And you see the depreciation of the dollar, again, showing up on those graphs. Now, very quickly, because I'm out of time, if we looked at what happened 30 days after Lehman, so this is interesting because it's a little bit, it's definitely is more of a reserve currency style response, but there's a little bit of heterogeneity. So if we look at the left-hand side, so most equities have been sold going to the US. However, there is a number of equity markets in which people have gone more into relative to the US. These tend to be more actually towards Asia, Asia Pacific, and definitely so Japan is there to the right. And if we look at the movements in the dollar, mostly an appreciation of the dollar except the yen, right, which is there, and marginally some other currency, but mostly the yen. So again, much more of a typical reserve currency move with a little bit of a twist for some of the equity market, but the exchange rate very clear about an appreciation of the dollar. And if we looked at long-term government debt, similar story, mostly going to US dollar and sell the rest, with the exception of, again, some more kind of Asia located markets. So much more a reserve currency flavor. COVID was the most reserve currency flavored. And the most recent ones, the Liberation Day, complete inversion of the patterns, right? So that relates very much, that's a way of monitoring the change in the network, right? To look at these short-term proxies for positions. And I think this is a useful way to inform us on the progress of a change of the US dollar as a reserve currency. And because this has consequences for what's going on in equity markets and bond markets, I think it is a useful tool for policymakers to assess the disruptions and the likely volatility, given that we do have market clearing on all these markets. So then if you manage your exchange rate vis-a-vis certain currencies, this has implications for the movement of the exchange rate vis-a-vis other currencies or of the equity prices. And so I think that's worth keeping an eye on if we have more massive shocks coming, in particular from the US, to take a look at this shift in financial architecture. And let me stop here.